How are you weathering the geopolitical risk first and foremost? How are you being pushed around by the market? Should you be protecting yourself?
Well, I think playing defense is absolutely word one right here, to use the football analogy. And it's not just geopolitical risk. You've got this spike in inflation to 40-year highs. We are bracing for a significant hawkish change in Federal Reserve policy. We're probably a month away from getting some more detail on that. And of course, you've got geopolitical risk in what we think are potentially three theaters. Everyone's talking about the Russia-Ukraine situation, but once we get past Lunar New Year and the Olympics, you've got to wonder what's going on with China and Taiwan, and then the ongoing nuclear negotiations between Iran and the United States have military implications as well as energy market implications. So all of this is weighing on the market to start the new year. We felt that there would be some risk. The market, dropped 12% or so in the first 3 weeks. We've bounced, but we are bracing for another move lower in coming weeks and months.
What do you make of the response so far by policymakers here in the United States? We had an administration, without getting too deep into politics, we had an administration previously that seemed to have much more of an eye on the markets and react to any sort of downturn with some degree of cheerleading, some degree with support. We seem to be in a different phase now where there's a lot more focus on some of the inflationary pressures, how you fight that, and not so much on whether we need to keep the market happy.
Well, the market is its own animal. And the reality is that we were up almost 30% last year and probably 120% from the bottom of the pandemic low in March of 20 through the end of last year. So I'm not sure that the Biden administration or the Federal Reserve, for that matter, really needs to be that worried about where stocks are. I mean, if we drop 10%, 20%, given how strong we've done, that's probably a healthy correction. But I think the administration, the Biden administration and the Federal Reserve, Jay Powell and his team, ought to be really laser focused on what's going on with regard to inflation. We've got a 7.5% nominal consumer price index for January that we saw last Thursday. That's a 40-year high. The core CPI up 6%. And the money number here, which we're going to see in 2 weeks, is the core personal consumption expenditure index. That number is probably going to come in around 5.5%. The Fed's target is 2%. We're running at 5.5%. They need to be paying attention to the data right now.
You talked earlier that you were expecting another leg down in these equity markets as we do get serious, as we count you down to about 8 minutes to this closing bell. What drives that? Is it the uncertainty from the Federal Reserve? What drives that next leg lower?
From a fundamental standpoint, we've already seen the spike in inflation, so it is how hawkish is the Federal Reserve change in policy. So we just had a strategy meeting earlier this afternoon, and I think we're on board with a lot of folks. Jim Bullard talked about it this morning, that maybe a 50 basis point rate hike in March is in the cards. Maybe 5 more quarter point rate hikes over the course of this year, maybe just skipping the November meeting because of the proximity to the midterm election. So you're talking about a total of 175 basis point increase in the Fed funds rate just this year. And then what does the Fed do next year? What does the Fed do in terms of quantitative tightening? There's some discussion that the Fed may shrink their $9 trillion balance sheet by as much as $1 trillion a year in each of the next, 3-4 years. We don't know what any of those numbers or policy changes are going to look like. I think the market's going to be on tenterhooks until we get some better news, some better information into the middle of March. The 15th and 16th of March is the FOMC meeting. So that theoretically could be the next leg down. We think at a minimum, there's a double bottom retest in the S&P at that 4,200 level. If that doesn't hold, the next really good number to us looks at about the 3,800 level. That would be down 20% from where we started the year.
Oh, and so if you are seeing such pain within equities, are you looking to get into cash? Are you exiting? Or are you saying, look, just find different pockets of areas to be in within the equity story?
So I'll tell you what we did a week ago today. Looking at over the horizon at that inflation number that was going to get reported last Thursday, we were concerned about the number being uglier than expected and the market taking a decidedly more hawkish turn in terms of what the Fed was going to do. So we took a percentage point out of domestic large cap growth. We're now 2% under domestic large cap growth. We stuck it into cash. Cash is now 5% for us, 2% over neutral. That's a huge amount of cash for us. So if you look at our portfolio now, we are overweight domestic large cap and small cap value, and international SMID and developed with a lot of cash. So what we're trying to do is play defense here, hunker down. We're overweight stocks that are cheaper, that are undervalued, that have lower betas, that have much higher dividend yield support. And the stocks that I've talked about are roughly 35 to 40% cheaper than the larger cap and the growthier domestic areas. So we're hoping to tread water here for the next couple of quarters until we can get a better sense of what the Fed's going to do, a better sense of what the trajectory of inflation is, and also a better sense of what those three geopolitical risks that we talked about, how do those play out? And our best guess is that we'll get some clarity on them late summer, early fall, and we'll be able to enjoy a nice year-end rally around the midterm elections. But the next couple of months, next couple of quarters are going to be a little choppy.
Definitely a little choppy, and people are looking for that clarity. When you look at some of the earnings that we've gotten out of this earnings season, which we're the bulk of it is we're pretty much through it, Phil. Does it give you, I guess, some encouragement with regards to the forecasts and the other guidance that we've gotten out of these companies that even given all of the geopolitical issues and the issues going on with the Fed and interest rates, that these companies, at least the ones in these indices, will manage through the storm?
Absolutely. Corporate earnings have been terrific. We're about 3/4 of the way through the fourth quarter earnings season. Consensus going in was looking for about a 20% year-on-year increase. We're up about 25%. 3/4 of the companies are beating consensus estimates by about 5 or 6 percentage points year over year. So the earnings have been very strong. Now, we are on a downward trajectory. Second quarter of last year, Romaine, was the peak of the cycle. Earnings were up about 90% year over year. Third quarter earnings were up about 45%. Fourth quarter earnings are going to be up about 25%. By the time the full year ends, earnings will be up about 8 to 10%. So we are in a downward trajectory back to normal. But we're not heading into a recession in 22 or calendar 23. There's simply too much stimulus, monetary and fiscal, in the pipeline.
And a lot of that can be made of still pretty negative real yields. It was interesting that PIMCO's Joachim Fels talked about this big global savings glut. That means that negative real yields are still here to stay despite nominal yields rising. Do you agree with that? And what is that telling you for your world of equities?
Well, we absolutely agree with that. And just look at the world of Main Street. All right, we talked about consumer inflation being up 7.5%, which is a big number, a 40-year high. Wages have also been growing. The last jobs report, wages were up 5.7%. The average person is probably saying, hey, I'm doing pretty well. My wages are up 5.7%. But guess what? You're 1.8% in the hole on a year-on-year basis based upon the fact that inflation is taking purchasing power away from you. And that's something that the average investor and the average consumer is very concerned about.